Now this chapter is sort of an introduction to capital budgeting and the various techniques, and one thing they want you to grasp here is that there's a relationship now between the firm's cost of capital, their minimum acceptable return, and the project's internal rate of return. As we talked in one of the videos, lecture videos, indeed, if a project has a positive net present value, the rate of return will always be greater than the cost of capital. This particular problem we're about to work sort of looks at that and asks you a few questions about that, and this is something important for you to understand in capital budgeting, and something this problem will indeed address. Now, this problem reads like this. It says a firm can purchase new equipment for $150,000. The equipment generates annual after-tax cash inflows of $44,400 a year for 4 years. A part, determine the net present value of the equipment, assuming the firm has a 10% cost of capital. Is the project acceptable? And B part, if the firm's cost of capital is lower than 10%, does the investment in equipment become more or less desirable? What happens to net present value? The other part of that B part of this problem now reads, what is the highest cost of capital that the firm can have and still find that purchasing the equipment is worthwhile? Now, that gets into the relationship between net present value and internal rate of return. Now, in this particular problem now, what they tell us is that the cost of the asset is $150,000. If we make that investment now, we're going to get $44,400 a year in after-tax cash flows every year for 4 years. If we require a minimum return of 10%, if 10% is our cost of capital, our minimum acceptable return on the investment, would we make the investment? Well, to calculate net present value, we find first the present value of the inflows. So $44,400 every year for 4 years, that's an annuity. We multiply the value of the annuity times our PVIFA with n equal to 4 and I equal to 10%. And that interest factor, by the way, is 3.1699. 3.1699 times 44,400, that's the present value of the inflows. Subtract from that the cost or the present value of the outflows, which is $150,000. And in this case, you get a net present value that's a negative $9,256.44. So one thing they want you to say is that, well, it's a negative net present value and you wouldn't make the investment. And the reason you wouldn't is because if we did, the value of the firm, the wealth of the shareholder, the price of the stock in the market would all go down. And indeed, the value of the firm would go down by this much, a negative 92.56. If you divide that by the number of shares that the shareholders own, the total number outstanding, that's going to tell you how much the intrinsic value of each share of stock would go down. That's not what you want to do. So the A part is net present value is negative. We don't want to make the investment, and we don't want to make the investment because we don't want to reduce the value of the firm. And the B part says, what would happen if the weighted average cost of capital went down? Well, as we said in other lectures here, there's a relationship between cost of capital and net present value. Indeed, if the weighted average cost of capital went down, net present value would go up. They're inversely related. They also want us to say, well, what's the greatest the cost of capital can be? Well, the greatest it could be and still be an acceptable project is to have a project whose net present value is 0. And that turned out to be 7%. So if you put 7% into this net present value equation up here, you'd end up with a net present value that's virtually 0. What that means now is when you have a net present value of 0, whatever that discount rate is, whatever that cost of capital is, 7%, that's also the internal rate of return of the project. You'll recall that internal rate of return is the interest rate that sets the present value of the inflows equal to the present value of the outflows. If they're equal, net present value would be 0. So as you look at this problem here, we would only be able to make this investment and not have a negative impact on the value of the firm if the cost of capital was 7% or lower. That's what your author wants you to see here. And again, kind of a look at the relationship between cost of capital, net present value, and internal rate of return.